makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Global stocks slide, bond yields climb after hawkish Fed minutes signal more rate hikes. U.S. Treasury Secretary Janet Yellen is due to in Beijing shortly for talks aimed at easing tensions between the world's two biggest economies amid an ongoing trade war. Plus, Meta takes aim at Twitter with the launch of Instagram's Threads. Millions sign up in the first few hours, but it's not yet available in EU countries. Also coming up, we'll take a look at the future of Britain's National Health Service on the 75th anniversary of the founding of the NHS. We'll ask what's in store for the creaking healthcare system over the next 75 years. But first thing is first, so let's check on the markets. A lot of focus is, of course, on the Fed minutes. Let me tell you what that's meaning for example, the U.S. 10-year yield, 3.9594. Now, what we found out with those Fed minutes is that a large majority of participants, some of them actually voted for a hike already last time round, but most participants are expecting interest rates to go higher from now. Now, what that means is, of course, we're seeing repricings across the board for some of these treasuries, and then the UK 2-year yield. Every day I wake up, and thank you to a lot of viewers that actually write in saying this could be the day where the 2-year goes as 5.5. We also have a really interesting note by JP Morgan talking about the fact that given all the composition of the UK economy, they forecast, or it's not a real, or it's at least a real possibility that Bank of England interest rates have to go out to 7%. Have a think about what that means for mortgage rate and also the housing market. The picture across Europe, we also look at France, where we have riots that have been erupting over the last 10 days. So we look at some of the underlying causes and what that means next. You can see Europe still in the green, and then we wait to see what happens in the U.S. as we have data. Now, joining us to talk about the markets and to talk about what all of this means for the next couple of months, Yacov Arnopolin. He is Emerging Markets Portfolio Manager at Pimco. Yacov, so good to have you on The Pulse. This is like a revival. We haven't spoken to you for quite some time, and you choose the most exciting day to come here because it's the day after the Fed minutes. And if you look at emerging markets, they, of course, are so dependent on dollar strength or not. How do you see the global economy developing from here?
Absolutely. Well, once again, thanks for having me. Great to be here. A lot of moving parts, as always, in emerging markets. We're following the Fed very closely, but I think what's been quite interesting is how much EM have performed this year despite ongoing fears about the Fed, despite ongoing fears about ECB, Bank of England, and so on. And it's been interesting that because EM central banks managed to hike rates so aggressively and so quickly, very much anticipating hikes by the developed economies, now they're actually at the point where they can start cutting rates, or at least pause, despite the fact that we're probably going to see another Fed hike in July. But
Yacov, do you worry, and there's this funny little thing actually with the Fed, is that they keep on saying and they keep on telling the markets that they're going to hike. The market doesn't quite believe it because then maybe they look at credit crunch, they look at some of the lending data. Are you expecting the Fed to be more aggressive than it's priced in, and what does that mean for emerging markets?
Yeah, of course. Look, it is plausible that we see more than one hike this year. I think having said that, when you compare the US to Brazil, where rates are at 13.75%, where real rates are positive, and we see positive real rates across emerging markets, whether you look at South Africa, you look at the Czech Republic, that protects these EM central banks and, again, allows them to actually go in the opposite direction of the Fed, even if we see further tightening out of developed markets. And it's interesting because if you look at how well EM currencies have done year to date, that kind of reinforces the case for potential easing by EM central banks, because the inflationary pass-through goes the other way, right? So stronger currencies, less inflation, so consequently potentially room for these EM central banks to, I wouldn't say ignore the Fed, never ignore the Fed, never ignore the ECB.
Never ignore the Fed.
Never ignore, but nonetheless, because they've been so aggressive, actually go in the opposite direction.
Right, but what the Fed is doing is repricing dollar, right, at the margin, and certainly changing treasuries. So that change the composition of what we're seeing in certain emerging markets, in investor appetite.
Yeah, it's interesting because EM has faced every possible shock one can imagine over the past 18 months. We've had Fed tightening, we've had geopolitics, we've had politics, peak outflows, peak defaults. So now, after having gotten bloody, so to speak, EM looks pretty compelling, both on the currency side, on the bond side, and again, not to ignore the Fed, but nonetheless, it can actually, let's say, have a pretty decent runway over the next few months. One thing we're just mindful of is, again, in the face of potential further Fed tightening, or at least the Fed then staying on hold for a while, when we think about EM central banks, they tend to, we say that they go up in an elevator, in a lift, as we're in the UK. Yeah. They go up in a lift in terms of their rate hikes, so they hike very aggressively, and then they go down the stairs. So the cuts may be gradual, so it may take time, which again actually supports currencies more carefully.
Yeah. Yacov, I also want to talk about China, but Treasury Secretary Janet Yellen is actually expected to land in China later this hour. Now, she's aiming to find areas of common economic ground. She wants to open communication channels amid an increasingly turbulent relationship between the world's two biggest economies. And of course, her visit comes days after China imposed restrictions on exporting two metals crucial to keep technology industries, the latest escalation in this ongoing trade war. And so, Yacov, this is something that Janet Yellen said in April, that she wants to look after American interests while at the same time not hurt China economically. What does that look like, and how do investors take advantage of this if they can?
Of course. Well, anecdotally, I feel like I got a degree in geology over the past 24 hours, following all the precious metals.
The little components, right?
Gallium, germanium, it's been fascinating. Look, I would say on the China front, there are probably two tracks. The geopolitical track, the commercial track. To us, frictions will continue. If we don't see a détente near term, obviously they may be dialed up, dialed down, but ultimately, when we speak to our colleagues that follow Washington, D.C., it seems that the one area where there's common ground, where there's bipartisan support, is being hawkish towards China. With that in mind, certainly we hope that this trip kind of maybe reduces tension somewhat, but going forward, we'd still see ongoing tensions. Yeah. And I think with regards to how to take advantage of it and what we're seeing our clients do, there is actually, I think people are waking up to the fact that as we expect further noise, let's say, between China and the US, maybe China and Taiwan, people are looking at where they're invested. Yeah. And those invested in EM equities, MSCI EM, a benchmark that has 30% in China, 15% in Taiwan, basically half the benchmark is China and Taiwan, are looking at that and saying, well, maybe I should shift from EM equities into EM debt, which has far less exposure to those two. So it's almost like they're trying to shift exposure elsewhere and diversify.
Yeah, and that could be also decoupling or supply chains. Yacov, thank you so much for now. Yacov Arnopolin from Pimco stays with us, and we'll talk a little bit about Eastern Europe as well. Coming up, Europe's energy flows. We'll discuss that in our exclusive interview with Maroš Šefčovič from the European Commission. Our Maria Tadeo conducts that interview shortly. This is Bloomberg. Welcome back to the Pulse, everyone. So we're nearly a year on from the peak in European energy prices, a crisis, of course, that bruised governments, consumers, and business. It led to a range of responses from the EU, including joint gas purchases, and most recently, a gas trading platform. Now, our Europe correspondent, Maria Tadeo, is in Brussels with a special and exclusive interview for us. Maria, over to you.
Yes, good morning, Francine. And what a year it was for the energy markets. And we're joined, obviously, by Maroš Šefčovič, who is Vice President of the European Commission. Now, you put together what you said to me, this is going to be like a relationship matchmaking, but we're not going to find love. We're going to find buyers of gas. I know that you got to 10 billion cubic meters. That was the amount that you were able to match. What's inside the number? Tell me, who's buying, what kind of contracts, what came out of the total number?
I think we've been pretty impressed, first and foremost, by the demand aggregation, because it was much more than we expected, especially for the first call, but also the fact that that we've been oversupplied by the bids, because we got the offers for almost 17 billion cubic meters, and as you said, we matched over 10 BCM. And I'm glad to say that we managed to cover most of the European territory, including, I would say, the territories which are not easy to supply, like Moldova, like Ukraine, and they got they demand completely matched. And what I heard from Moldova was that also price-wise, it was much better than what they get from traditional suppliers. So the second round, which we are starting right now, again, we've been quite impressed by the demand. So it's already around 16 billion cubic meters. And of course, we start with international tender tomorrow. So by Monday evening, we'll have also the results, what been the bids and how the matchmaking will proceed.
So you will reach out to the sellers. And what is the next goal? Because winter, I mean, it sounds a little bit funny to say it's around the corner, but when it comes to the preparations, you know it already is. So how much can you get?
I think that we are permanently communicating with our member states, with all the energy players. Let's not be complacent. I mean, we managed last winter. We've been also a little bit lucky, but at the same time, everything had to fit in just to make it through the next winter as we did the last time. And therefore, we hope that by the end of the summer, we will have fully filled all the gas storage across Europe. And then, of course, we want to work with certain reserve, because you never know what might happen in our volatile worlds, and therefore we want to be fully covered for the next winter.
Exactly. You say we want to be on storage looking good in September, like we did last year. But on a scale from 1 to 10, how much do you worry about this winter? Because the European industry, they still say, yes, prices went down, but the damage, the repercussions, we still feel it. It's painful still.
It is. I mean, when you talk to our industry, they told you that the last year was indeed a year of survival. This is how they describe it. And this year they are telling us that still manufacturing and producing well below the potential, and we need to get them back to the market to fight for our industry, to make sure that they would prosper. And of course, they need not only enough of energy, but better prices. And therefore, we are trying also to increase the transparency, competition on the market. And of course, I would be definitely worried until the next spring. I think we are in much better position than we've been the last year, but definitely not be complacent, because it would be a big challenge.
Yeah, and of course, there's a lot of this talk still about this recession in Europe. But I wonder if your platform, if it becomes successful and it becomes a role model for the way that you can connect both buyers and sellers, do you see this being extended to critical raw materials? Just as one idea, the Commission wants strategic autonomy. Is that doable?
I think there are definitely, I would say, two new directions we should take. The first one is to use the platform for the common purchase of hydrogen, because that's the next big thing. But also, I think it could really serve as an excellent blueprint for the common purchase of critical raw materials. I mean, we see, you know, how this new rough geopolitical world is also impacting the global supply chains and supply of critical raw materials. And I think we as a Europeans should pull our political weight and economic size a little bit better than we did until now.
And you say the European Union should pull that weight. And we've seen now the Council says, yes, no to decouple from China, but yes to de-risking the economy. Yeah. The Chinese responded this week with some exports controls. Is that a warning that they say you want to de-risk? Go ahead, but it's going to cost you and expensive?
You know,
I
think that we've been kind of expecting that sooner or later this might come, and therefore, I mean, I was pushing for already quite some time that we need to have this open strategic autonomy. We need to be able to diversify our suppliers, because we are paying a lot for dependencies. Look, you know, how much the dependency on Russia's supply of gas and oil costed us until now. And therefore, we started with our Critical Raw Material Act. We want to proceed with strategic stockpiling of critical raw materials and use the platform, as we did for the gas, as a blueprint for doing something similar for the critical raw materials. So we definitely have to invest much more in critical raw materials to have the strategic supplies we need.
But you don't worry about potential retaliation, or you do, from the Chinese, who say, okay, sure, you want to do that, fine, but we provide a lot of them.
Of course,
we pull the strings.
Yes, of course, we analyzing the current situation and discussing it now among our member states. But I would say the conclusion is very clear. We need to diversify the suppliers. We have to prospect what we have in Europe, what we have in our neighborhood, and bring enough investment to develop the possibility of diversification of supply chains of critical raw materials for our key industries.
And of course, speaking of the Green Deal, which is still the cornerstone of European policy for the future, there was a story today we had on Bloomberg which suggested the cost of this could now go incrementally to 700 billion euros a year in investment. To make it clear, this is from the private sector, not taxpayers. But I do wonder, that bill goes in crescendo pretty much every 3 months. What is going on with that? Why is there this big gap between how you started, where you budgeted, and where we are now?
I think a lot it has to do with, I would say, overall price developments, on the global markets. But at the same time, it's also the fact that we want to accelerate this process, because we have seen that we cannot be dependent on the fossil fuels.
Even if it costs more.
Even if it costs more, it's a matter of economic security. It's a matter of using our indigenous sources of energy like solar, wind, hydro, nuclear. and to make sure that we will be much more, let's say, independent from the perspective of how we generate
and on this
the energy.
Do you think the European taxpayer is going to stay with you on the Green Deal? There's a lot of pushback at times. It's too expensive. I don't see what it does in real life.
I think we, of course, have to be very conscious about the fact that we shouldn't talk only about the importance of the green transition, but also how we are going to protect the most vulnerable parts of our society who are impacted by this change. I think that green and social have to go together, because otherwise, I mean, it's very difficult to make these transformative changes if you do not have enough of the public support. So I'm one of those who say green is great, it's important, we have to do it, but it has to come together with the social policies to match it.
And you also have the European elections next year, where that will be at play. And then a final question, I have to bring it back to the UK, because I know you've left that chapter of your life, but you can't fully escape it. So here's my question to you, but it is connected to Europe. However, you do know that there has been reports about this EV possible tariff that could be implemented to both cars that are made in the UK and the European Union, unless there's a number of components that are made in both markets. The UK government says this could kill, made in Europe EVs, but also in the UK. The European auto industry says this is dangerous too. Do you see potential to have some leeway there so that this does not get implemented?
Our approach to this is quite clear. We are pretty sure that if we will not give our battery sector the chance to grow right now, we might never have it. Because, I mean, we know that there is a hockey curve in the acceptability and sales of electric vehicles, which will be here between now and 2026, 2027. And if our battery sector will not be part of it, so there will be takeoff agreements signed with, let's say, Chinese suppliers, and for them it will be very difficult to recover. So this is very important for us, because batteries would represent 50% of the value of the car. So therefore we want to give every chance to battery sectors to prosper.
But would you reconsider this tariff? If the industry in Europe says it's going to cost a lot, and the UK government also says this is going to hurt us both, is the Commission potentially open? Maybe not today, but consider reopening that? You know,
we are afraid that if we kind of get soft on this issue, that in 3 years we would have the same discussion as we have right now. So therefore, I think that we have to put everything on the table, and as it stands right now, we want to make sure that our battery sector is prosperous enough, and it's delivering, and it's becoming the part of the value chain we have to build across Europe. Well, Mr. Šefčovič, thank you so much. Always good to see you on Bloomberg TV. Good luck with your new round of tender offers for your platform. We'll see how it goes. Thanks so much. Thank you. Francine?
Yeah, Maria, thank you so much. Maria Tadeo and the EU Commission VP there. We're back with Yacov Arnopolin. Yacov, this was a great conversation, really trying to push, the Commissioner on the plans, first of all, for some of these raw materials. As you say, we're all experts in what China's trying to do and how we could try and counter that. But also energy. So if you look at emerging markets, and this is not only Eastern Europe, how much is the potential high energy price a real downer for the next couple of years?
It's curious, because I would say, focusing, let's say, on Eastern Europe, we have more exposure to the region than in living memory. And a lot of that has to do with the fact that energy prices are well off the highs. Yeah. And on the back of that, we're seeing really a smattering of downside inflation surprises, obviously, versus expectations. So that's actually quite encouraging. So with that in mind, we have quite a lot of exposure in Czech and Czech-in in the local bond market. We're looking at the Hungarian forint. And on the credit side as well, between lower inflation, but also, hopefully less geopolitical friction and political friction. A lot of the Eastern European countries, their credit, so dollar bonds, euro bonds, places like Serbia, places like North Macedonia, Romania, are quite interesting at the moment.
Yacov, as always, thank you so much for joining us. Yacov Arnopolin, their emerging markets portfolio manager at Pimco. Don't be a stranger. It's been way too long since we had you on last time. Coming up, Meta's newly launched app is taking aim at the Bluebird this morning. Elon Musk has fired back. We'll discuss a new risk for Twitter next. And this is Bloomberg. The Meta founder, Mark Zuckerberg, says its newly unveiled social media app, Threads, has reached 10 million signups so far this morning. Now, the app is taking direct aim at Elon Musk's Twitter. However, it's not launching in the European Union so far due to regulatory issues. Well, joining us now is Bloomberg's Alex Webb. Alex, we've all been playing around with Threads. I have to say, it's fantastic. How does the functionality compare to Twitter?
I guess there are two pieces to this. There's whether the social graph that it's built up through Instagram is able to build the connections pretty quickly that you would want in a social network. And so far, it kind of looks like it has, because it's able to port users over from Instagram itself. That's something that these other would-be Twitter competitors have struggled to do, because they just don't have that existing social network. On the functionality of the app itself, there are a few things that aren't quite there yet, and which presumably could be quite important. Not least, there isn't a desktop version, which for a lot of power users, and by that I kind of mean the media, they use it on their desktops, not just TweetDeck, but in browsers. That could be a bit of a hurdle when you look to trying to get people engaged with it throughout the day, that people constantly have Twitter open. It's going to be a bit harder with Threads with no desktop. There's no live stream. There's no sort of Twitter Spaces equivalent. Those sort of things presumably will come, but they're not here just yet.
Thank you so much, Alex Webb.